Okay, let's do the intro.
Hey, Value Nerds. This is Value After Hours. I'm your co-host, Jake Taylor. And today with me, I've got our usuals, Toby Carlisle and Bill Brewster. Hey, Bill, what are we going to be talking about for your segment?
We're going to talk about Cleveland Cliffs using undervalued currency to complete a transaction.
Toby?
Morgan Housel's tweet about Buffett buying Bloomberg. And Jake, what's yours?
I'm going to be the party pooper and talk about $10 trillion worth of U.S. corporate debt.
Ooh.
Well, that sounds good. Right after the break.
Tobias Carlisle is the founder and principal of Acquires Funds. For regulatory reasons, we will not discuss any of the Acquires Funds on this podcast. All opinions expressed by podcast participants are solely their own and do not reflect the opinions of Acquires Funds or affiliates. For more information, visit acquiresfunds.com.
I've been reading the book about Simons.
Yeah. Is that any good?
It's very well written. And the reason I'm reading is because Gregory Zuckerman reached out to talk about coming on. He's going to be on my podcast.
Oh, nice.
And so I'm reading it but I haven't discovered anything in there that I didn't already know.
Yeah.
Basically, so there's no secret, to what they do. Greg doesn't know. If there is, Greg hasn't shared it.
Did you tell him that? Were you like, your book's not very good. There's nothing I
Well, the
don't
book is
know.
good. Like if you hadn't tried to find, like I've tried to figure out what they're doing for years.
Yeah.
And I've come to the conclusion that nobody really knows. And I think what he says in the book is nobody really knows, and possibly they don't even know.
Yeah.
But I do think what they're doing is kind of smart. So what they do is they've just got countless. What they're doing is they've just got countless of these little strategies where they've found little anomalies in the market and they trade them, and they trade them to the point.
Out of them.
Yeah, they just trade them to the point that they arbitrage it away themselves and then continue doing it. So nobody else can even pick it up that it's there.
That is some gangster shit.
It's smart. I get that. I don't think they'll blow up the way. I don't think they can blow up the way long-term capital management did. I don't think they can blow up the way any of the other quants do, because I think they've got, and I do think it's smart. You just build out, as many different strategies as you possibly can. They all get a little bit of the portfolio.
Do they use leverage though?
I think they do.
Because you can't tell me at some point things don't correlate together, like auto-correlate.
Well, they do. They definitely did, right? You've read the book, haven't you, Jake?
I haven't read that one yet. No.
There were definitely times when they've overridden the models. Like there was the quant quake in 2007, and there was another one where they overrode the models, and Simons just stepped in and said, we're not going to do that because, so everybody knows when momentum breaks down,
it breaks hard.
Yeah, so momentum goes down really hard, and then it doesn't work
for a bunch of people buying because it's higher, selling because things are going lower. That's amazing. Who would have thought?
Dude, it's the most annoying thing when people say to me, like, how do you know that, like, deep value is going to come back? Because it's so easy to implement. It's so over arbitrage. I'm like, you're right. It is not really hard to implement, but it's harder to implement than momentum is. And momentum's been working really well. So explain that one to me.
No one's asking those questions.
But the interesting thing about momentum is when it does break down, so it has the big drop. The drawdowns are sickening, and then it doesn't work for a year after the big drawdown because the signal's broken. And so I think Simons understood that, and he said, we're just going to not trade this momentum strategy for...
It's on a timeout.
Yeah, we're going to turn it off for a moment, and we're going to just make sure we survive because we want to keep this as a good business. And then they turn it on a few days later because they're not using 1 year momentum. They're using all these different little short-term trends. And it seemed to work and they survived.
Well, that's what Greenblatt said too, right? Where he was that isn't what I need to work on my phrasing things in a podcast. But what you are saying about momentum is what Greenblatt said, in that if momentum ever breaks down, he's not going to be able to stick with it. But buying stuff cheap is just something that he's like, no, fundamentally this must work. So this is what I do.
Right. Because it makes logical sense.
That's right.
That's one of the interesting things about what Renaissance do, is that they don't look for things that make logical sense. They just find the anomaly. And if the anomaly is robust according to their sampling statistical methods, then they implement it. Which I think is kind of interesting, because that's one of the, they always, the argument for why backtesting doesn't work is that you find these things that aren't real, right? You just find these flukes in the data. And then you implement that. So they're literally going out there and trying to find these things, and they're not worrying about the explanation. But, Taleb says you need to be careful of those sort of things. But then I can fit an explanation. I'll go and work at Renaissance, and I'll come up with the reasons for why the anomaly exists. Like, I'll come up with a good story for it.
Of course, yeah.
I think that's the easiest thing to do, right? You fit the story to the data.
Aren't they? They're like the ultimate argument for just random ass data mining, right? And not
that it works.
Everyone's always like bashing it, but these guys have done pretty well.
It's kind of an interesting approach, though, right? You say, we're going to go out and look for these things and not try and fit a story to them. Then how do we assure that they are real? And then that's a data science question that it's kind of beyond my abilities. But I don't know how they do that, but they must have some sort of, they take voice recognition type work, and they do code breaking and other things like that, and take those skills and apply them to anomalies that they find in the market. I find it interesting.
Anyone that can do what they did is insanely interesting. I mean, that's crazy.
And still going.
Yeah.
I saw somebody the other day said it's like entering a Mack truck in a Formula One race and consistently winning.
Huh.
So, Bill, do you want to kick it off with your topic?
Yeah. So something that came into the news recently was Lourenco Goncalves at Cliffs Natural Resources, or Cleveland Cliffs, used to be Cliffs Natural Resources, and he is using stock to purchase U.S. Steel, I believe. And I find the transaction pretty interesting. I'm going to read an excerpt from his 2 conference calls ago. He says, "We increased the size of the share repurchase program and bought back another $130 million worth of Cliff shares in the second quarter, bringing the total amount of the buyback to $300 million since inception. Other than this expansion project that they're undertaking, yada, yada, yada." Anyway, he says, to the short sellers, "I want to thank you very much for the shares that we bought back. You sold your shares very cheap. Again, thanks for your gifts to Cliff shareholders. Besides the new normal for iron ore prices, the other view that drives our moves going forward is that the current weakness in the domestic steel market is temporary." So I guess that's consistent with purchasing U.S. Steel. The thing that's really tough for me to wrap my head around is here he is saying thank you for selling your shares very cheap, and then he's issuing shares that are now 30%, 40% lower than when he had this conference call. And it complicates the story. The story used to be they had these pellets that were premium, and they had a distribution advantage that they could send the pellets on rail down to these HBI plants, hot briquette iron. It's a better way to manufacture. And now he's turning this, what I think is a fairly clean story, into an integrated steel manufacturer in the U.S. that appears, at least to me, to be somewhat dependent on tariffs and using cheap currency. And I just think it's one of those interesting examples of somebody being in a less quality business and having to take actions to try to either grow the business or justify its existence. And it's just so the opposite of something like Starbucks, where the decision is just build more stores. And I just think it's interesting, and B, a pretty good example of Buffett saying bad businesses throw up bad decisions.
Difficult decisions.
Yeah, that's right.
Yeah. I would say that maybe we all need to add to our investment checklist. Taunting short sellers is probably a good sell signal for you. You just never want to be. You don't want to tempt the gods like that, right?
I literally just wrote that down as one of the points that I wanted to make. It's just not a good sign when somebody's out there bombing on the shorts. No good CEO even cares what the shorts are doing because they just know they're going to get beaten up in the next.
Run your business. Don't taunt short sellers.
Who cares what the shorts do? It's bizarre because shorts are doing lots. Like I short over a short time frame. It could be nothing. Doesn't necessarily. It's not a comment on the everlasting business. It's a comment on the business where it is at the time, or the stock price where it is relative to the business. It's a silly thing to say.
Well, I think it's super interesting. I have a part of me that really likes that. You know, there's a part of me that likes the hubris of it, and I don't mind. Money Mayweather is a guy that I used to root for. I mean, I sort of like the villain coming out and winning, and the hubris of it. But I do contrast that with Robert Pera from Ubiquity. When the shorts attacked him, he did go to Twitter and he said something about short sellers. But a lot of what he wrote, they invited him on CNBC, and his response was, "I'm not going on CNBC. I have a business to run." And
good line.
That's
correct.
Correct.
I mean, it really is. And I think shorts got on him for that response because he did take a quick shot at short sellers, but he wasn't on conference calls going at them. And I should have not listened to the part of me that roots for entertainment, and I should have listened to the investing part of me. I mean, thankfully, I'm out of the shares already, but
some CEOs are just great sport. Like Musk is great sport. Like I like Musk personally. Like I think and I love watching his Twitter feed, and I love watching him go back and forth. I'm not a huge fan of Tesla, but I kind of like I do like the shenanigans.
It's entertaining, and for a while with Goncalves or Clavis, I'm sorry if I keep pronouncing it incorrectly, but he was backing up the talk, and I like that a lot. But I don't know. The more that I
but how about the thing where he's on one hand he's using shares to buy, he's issuing shares to buy U.S. steel, right?
I'm pretty sure it's U.S. steel, yes.
And he's saying on the other hand they're too cheap. Someone needs to send him that book on capital allocation by Jake Taylor.
That's exactly my point, right? I mean, Jake, you need to call this guy.
I think that was The Outsiders. That was the one that you were thinking of.
No. It was clearly yours.
Some people need that narrative voice.
That's true.
Well,
I do
right.
wonder what I don't know. I haven't looked at the specific financials of either of the companies in quite a while, but like, what did he get for his giving away part of the company?
Yeah, so I think that it looks like it's AK Steel. Okay, so sorry. But regardless, if you pull up the stock price of AK Steel, it is apparently, going to be a decent deal for Cliff. So he would argue I'm buying a more undervalued asset than I'm giving up. But if you pull up a long-term chart of any of the U.S. steel makers, which, I mean, a chart can only tell you so much, but over a long duration, I do think it tells you something. They're not good businesses.
Well, they're pretty beaten up at the moment. I think they're cheap.
Well, if you look over a long, long time, they never really get expensive.
And it's a commodity. It's a commodity product is the problem.
That's right. You're
Cyclical
dealing with
commodity.
all types of stuff. You got China, you've got a lot of dumping. I don't know. It seems to me that he's muddying the water, and it's a more complicated story, and he's issuing what he deems cheap currency. It doesn't make a lot of sense to me.
Could you do it with debt?
Well, so the problem, and this goes back to the bad business giving difficult decisions, he is building out a huge facility. It's an HBI facility, and I think that's going to be roughly $1 billion, and that's where a lot of the debt is pledged to that project. So if he wants to execute this transaction today, the debt capacity really isn't in the entity. So you've got to issue equity. But, maybe that's the trade-off for starting a big project like that, is you don't get to buy another company.
Right.
I think that is one of the interesting things of watching different managers and their pace of play over decades. So, you watch Berkshire as sort of on one end of the extreme of they've always had more cash than they probably could have gotten away with. They've always been like one. They've always been N-1 acquisitions. Whereas other companies you see, like they're oftentimes trying to bite at the apple more than maybe they should at that time. And they could probably stand to operate their businesses and build up some resources before going to try to tackle that next thing. And, I guess there's probably some perfectly optimal point of how aggressive you should be. But I would say that like betting in one of them, I would be able to sleep much easier at night compared to the other one.
I heard on a podcast, and I'm sorry, I forget exactly which one. I think it was Dan Ferris on the Investors podcast, but he said, I think after Buffett did the Cap Cities deal, he didn't do anything for 3 years.
Yeah.
You got to digest that, right? I mean, it takes time.
That's a long time to have the bat on the shoulder, though.
Not if you're thinking in decades.
Well, that's true.
Well, and you look at what they just walked away with this Tech Data, right? Isn't that the company Tech Data that they just sort of, I guess, didn't miss the bid but got outbid? Part of me says, well, boy, if you've got something in the crosshairs and you're sitting on all this cash, stretch a little. And I know that that's very not Berkshire.
So late cycle talk right there.
It probably is. That's fair. That's fair. Guilty as charged.
YOLO!
That's right. But no, it is late cycle for sure. But the other side of that is if you're thinking about 10 years down the road and you say, and I got this thought from my guy, Science of Hitting Investing, it's beneficial to walk away, to say, look, we're going to put one bid in front of you. We're coming over the top of a bid that you've already accepted. So this is a good deal. You shop us, we're gone. And that makes a lot of sense if you're playing the long game.
For sure. I own Tech Data. Sold it before the bid came in, though, so don't get
well played, sir.
Yeah, thanks. Thanks. I deserve everything I get for that one.
Up for market timing.
I can't win them all.
Well, you were in the right pond, so I congratulate you for that.
Look, I feel pretty good. I've been getting into a few positions before. So I was in HPQ before Icon showed up. I feel good. I think that value is starting to make sense again. Like for a long time, I feel like for the last 5 years, value just hasn't made sense. You buy stuff and it just goes down. Just rebalance out, buy some more stuff and it goes down.
Well, you think that there's starting to be more M&A in your type of investment that
100%
pulls for, like unlocks like that catalyst that everyone always loves to think that they have?
I think everything's just been dormant for a while, but like the last 3 months in particular, I feel like the activity's just exploded.
Huh. Does that show up in the data? I haven't seen anything recent on M&A activity.
I don't want to look in case it's not true. I just want to enjoy the feeling.
Okay, fair enough.
I found myself listening to our old podcast. I'm one of the fans.
You're one of the dozen downloads we had.
Yeah, 2 views.
Yeah, potentially a little conceited there, whatever. But I was listening to your HPQ pitch, and I thought, Toby's got an interesting one on this one. I mean, if that doesn't work, like you said, nothing's going to in that entity. At least it doesn't seem from a high level, right? I mean, I don't know all the details, but
it's not a modern value position. It's not a compounder, but it's undervalued, and it's not going to go away. To the they make the worst printers in the world, but nobody else makes good printers. So what are you going to do?
Yeah, what is that? How come there is no home printer that is worth anything? Like I get 8 pages out of a printer before either the ink goes away or it just totally goes to hell in a handbasket. What is that? We're not at that level of sophistication as a species.
Well, I'm used to working in law firms. You get these things that are the size of a family car, and they just pump them out. Now, I've had lots of them break down. Like the time that they like to break down about 4 a.m. in the morning when you've got something that you have to file at 9 in the morning. Yeah, and all the air conditioners are off, so you're sweating like an animal trying to get this thing to work, panicking.
Space at the end.
Fortunately, because every firm I've ever worked in, it was over like 3 floors, and every floor had like 10 printers. You just go down to the next one, but I just leave them broken open because it was. But at least those things did work. Like those things were pumping out thousands of pages every day. I ask mine to print out about 5 pages once a quarter, and
it won't do it, right?
We're out of ink. I just bought some ink.
3G's got to take over some law firms and get that printer pages down, right? Yeah.
That's back in ancient history, though. They probably don't print stuff out anymore. I don't know.
I was thinking about just stacking them on top of each other as they break down, so that the new one coming in knows, like,
this is what happens.
There's dead bodies here.
This is the graveyard of fallen printers.
There's not a person who hasn't watched that Office Space movie where they beat that printer up with the baseball bats that didn't just, like, that moment of catharsis, like just kicking
so cathartic.
Such a what's the I forget the error, HP print error or something like that.
Yeah, I was trying to think about what it was to drop that as a joke, but then I couldn't come up with it. Like,
too hard.
One thing, just circling back to the actual discussion that we were having, the interesting thing that everyone agrees on today is compounders are where value should go, right? And I've said before that works, but eventually the outcomes look rosier and rosier, and it's a self-fulfilling prophecy, and eventually the price gets to the point where it doesn't make sense. There are so few cigar butt investors out there anymore that
they're all broke.
Yeah, well, it's just hard to think that that's going to stay that way forever. I mean, by definition, that markets evolve, and that should be, in theory, a place that eventually has strong outperformance, and then...
It's the law of ever-changing cycles. It's Victor Niederhoffer's Education of a Speculator. He talks about the law of ever-changing cycles. Basically, you got to be looking at what has just worked is what's not going to work. The thing that has not been working is the place that's a better place to bet. That's mean reversion. That's deep value investing.
Boy, you're really talking your book right now.
I'm flogging a dead horse.
Yeah.
It's not like you've spent any time thinking about this, right?
Yeah.
I'm a bulldog. I'm never going to let that go. I'll be 80 years old still talking about values just about to come back.
It's just hang in there one more quarter.
At the wrong time to have my career.
Isn't that a shame?
It does feel that way a little bit, huh? Like, I mean, have you imagined the guru status that you would be walking around with every day if you had launched in 99?
Wow, that's
He's
true.
Walter Schloss. This man is Walter Schloss. I'm telling you. Now, it may not be the right time to be Walter Schloss, but I do think eventually you're going to be proven correct.
That's
and
very
I will
kind.
be there saying, I've been saying this for a while.
The thing I find, like, Walter Schloss is like the redheaded stepchild to Buffett's golden-haired boy, right? And the crazy thing is that Schloss did like 20% a year for 50 years. Like, only beside Buffett is that not a good record.
The guy's a beast.
Yeah, he picked the wrong comparison to ever, like, don't get into that pool. Like, don't play Michael Jordan at basketball. Like, even if you're really good, that's going to be a bad outcome for you.
Well, and the thing I love most is he did it in like a tiny little office space, and he borrowed somebody else's copy of Value Line to do it. Just flicked through Value Line. He couldn't have, and he walked home at 4 p.m. every day.
Did he really?
Yeah, it was like lived a couple of blocks from I think that's right. Lived a couple of blocks from his home. Like, just the market's closed at 4. He was like, well, there's nothing to do. I'm going home.
You know, that reminds me a little bit of, and if any listeners don't know this guy, you got to look him up, is Arnold Vandenberg. I mean, I got to listen to him speak. He is one impressive man. But
his backstory is unbelievable.
Yeah, it's harrowing, isn't it?
It's crazy. And he was talking about when he was getting started, his wife, wanted to borrow a little bit of money, and he just didn't have it, and he wrote her out this check for, I think it was $125,000 or something. They clearly didn't have it. And he, it was one of those, put this in your cabinet, I'll make sure that I can pay it someday. And he
great.
manifested it. I mean, that's why he loves to talk about that Think and Grow Rich book. But he was talking about drinking wine, and he said, I'll never drink wine. It's just not my DNA. That's not what a value investor does. And then I thought to myself, darn it.
Well, there are lots of different types of value investors out there.
That's right. I'm the Munger type. I want to live a decent life while I invest.
So, Jake, what's your topic?
Well, I'm going to be Debbie Downer, I think, in this for this discussion. I saw this article and I followed up with some more research on it into some more of the primary documentation of where it came from. But the U.S. corporate debt is approaching $10 trillion. So we've been borrowing a lot of money at the corporate level, and that's to fund $3 trillion in buybacks in the last 5 years.
Fake news.
Yeah, I know. Well, right now, another data point I saw was that it's $250 trillion of government, corporate, and household debt right now, which is about 3 times global output, and it adds up to about $32,000 per human on Earth. So I don't know what you do with that number, but it's like such a huge number. It's just kind of surprising.
I saw something like this on Twitter, and I saw somebody responded. It was Jake at Economic probably, and he said that the scale of, I think, GDP is up commensurately with the debt. Is that fair, do you think?
Well, I don't know. I mean, I think that 3 times global output to me says that that's a pretty big number. I mean, didn't Rogoff and Reinhardt's studies show that like once you got over about 100 debt to GDP or whatever kind of output number that you want to use, you started to run into problems?
I thought they found out. Wasn't there like a hard-coded cell in the Excel spreadsheet that their research assistant, and that disproves the whole thing? I'm joking there. They actually did find the hard-coded error though, right?
Yeah. I don't know if that like totally we can throw everything that they said in the garbage because of that. I don't know. But I do think like here was another thing. I read this IMF study that came out here recently. And I know like why am I reading IMF studies? I don't know. But
you're a macro guy.
The just Fed's crying reading IMF studies. Why so much debt?
I've turned into a macro guy. Yeah.
Rolo's become Rolo. Just roll the debt. You're fine.
Well, that's an interesting transition because what they, and granted, like you have to take everything with a grain of salt here, but they said that if there was a slowdown that was half as bad as the great financial crisis, that 40% of the total global corporate debt, which amounts to $19 trillion, would be at risk of not being able to make interest payments. So that's half of the GFC that we were all around for. If it's half as bad as that, there's all this debt that is probably not money good.
It's just going to be inflated away, isn't it? That's what the central banks of the world are doing.
Well, so this by itself is kind of an interesting conversation, but I think where I'd like to go with it would actually be like, what are some of the second and third order effects of this much debt? You know, if you think about like these zombie companies, which I've seen 2 different numbers, like anywhere from 6 to 10% of companies today even don't have enough earnings to cover interest expense. Why
aren't they collapsing? Why aren't they going through bankruptcy?
Because they're able to borrow more money and just keep the game going. Roll it over.
Low.
Yeah, roll low.
I like it.
What does that mean for profit margins of the companies like that exist today that are competing with these companies? What does that mean for the amount of demand for other things? Like there's so many implications to this. I don't know. Like where do you guys' minds go with that?
I don't want to get too macro on this. I'm going to try to tick some of my thoughts off quickly. Whenever I see these numbers, I think of AB InBev because it's something that I'm somewhat familiar with. The debt maturity schedule on that entity is a lot less scary than the headline number.
Okay.
So I think to the extent the debt markets are willing to accept long dated paper, issue it with rates this low. And then if rates go lower, you roll it, which brings me to another point. In my opinion, I don't allocate much right now outside of government paper to any corporate paper because I don't think there's yield commensurate with the risk that you're taking.
So to give you a number on that is the BBB rated debt right now, the spread between that and higher quality paper in 2009 was 7%. Today it's 1.4%.
Yeah, you've got a ton of spread compression.
Garbage.
There's a lot. Yeah, there's a lot of people that are looking for yield, and I found an interesting thing when Grubhub reported their earnings and they wrote that letter. I thought to myself, I wonder what the debt looks like today. and I pulled up their credit agreement or the bond debenture. The definition of EBITDA was roughly 4.5 pages long. Now, some of those adjustments make sense. And, somebody would probably tell me they all make sense. That's crazy. EBITDA doesn't need more than seven lines, right? So long story short, I think there's a lot of risk in the debt markets. I don't know that it's a huge risk for the equity markets. Now, someone at Grants or something is going to call me an idiot and tell me, what happens if they're all cross-defaulted, and that's a real issue. The only other macro thought that I do get to thinking about when I hear these things is debt does pull forward consumption, and I do think we're starting to potentially see GDP slowing to what I would deem concerning rates, and I do wonder how much have we pulled forward. But
about $250 trillion by my math.
Well, I put a lot of this in my too hard pile, but that's where my mind goes.
I saw Rogoff speak at a macro conference that my buddy Chris Cole invited me. There's no reason why I should be at a macro conference. He had a spare ticket, so I went along, and I was kind of interested, like what happens at a macro conference, what do macro guys talk about. It's pretty interesting, actually. Macro guys are like special situations at a macro level. Like they're all talking about, there's little triggers. If this happens, then this is what happens in a pretty direct way. Some of the ideas, some people are talking their book, but some of the ideas are pretty interesting. Rogoff was like the headline speaker, and it was just after the scandal where his research associate had found the hard-coded cell or whatever it was that made some error. So Krugman had just eviscerated him in his column. And so I thought this is going to be really interesting because Rogoff's probably, a little bit of a firebrand. He's probably going to get up and say something about, governments shouldn't borrow too much. Like, I think that's got to be the case, right? Governments fall over all the time. The Asian tigers defaulted in the 90s. Russia defaulted in the 90s. The South American economies default all the time. Like, default is a natural state. I think the US has defaulted too a long, long time ago, not for a very long period of time. But most countries default eventually when they get too much debt.
Well, we're on our third central bank, right? I mean, that's a form of defaulting. Sorry, keep going.
No, that's interesting. I was aware of at least one other, but Rogoff got up, and Rogoff is the most mainstream. Rogoff just delivered exactly what every other economist out there says. Like Rogoff, and there's no difference between Rogoff and Krugman. They have exactly the same views. I was kind of blown away. I was like, what? Why did you put out this big paper saying that there was some issue, and he didn't defend it at all? I thought it was utterly bizarre.
Let me ask you guys this: if I feel like that there's some of that dynamic of like standing up at a parade where if everyone's doing it, it makes sense, but then in aggregate, it really starts to not make sense. So think about borrowing all this money to do share buybacks. Individually, it seems like it makes sense. Like borrow all this cheap money, it's long dated, and then buy back your equity. By the way, like corporate profits in the U.S. peaked in 2014, and it's all been just share shrinkage to drive EPS up since then.
Is that right?
I mean,
I looked at S&P 500. So I looked at S&P 500 operating earnings and earnings pretty recently, and I thought it was it had bounced back up to look like it was pretty much at all-time highs.
I think it. Well, I'll try to find the chart. I'll send it to you. Maybe we can post it somewhere. Yeah, could be. I mean, sometimes I feel like those numbers, like
definitely softened.
The earnings numbers, can be.
It softened and it was off, and then basically from like sometime in 2016, it bounced. So the market didn't ever follow the earnings. The earnings kind of fell off and then bounced, and the markets kind of just proceeded on.
I guess how much of that was tax cut related? It would be the only follow up, right? But
animal spirits.
I mean, what Starbucks did makes sense. I get that. They didn't have a lot of debt. That balance sheet can handle debt. You're selling something that people are addicted to. I'm not worried about stuff like that. But And I'll probably die on this hill. This is part of why I believe in active. I think in aggregate, it's hard to argue to me that there's not going to be some negative consequence to all the debt. A lot of these companies can handle it. So make sure you're buying companies that can handle the debt is my suggestion. And then don't pay too much. And then if you find them cheap, call us.
Yeah, it's like an existential angst for me that I think that there's way too much debt. But I've kind of been working for about 20 years, and I've watched the debt. Like they said, 10 trillion was like unsupportable, and now, this is U.S. government debt. U.S. government debt at 10 trillion was unsupportable. I don't know what we're at now, but it's like 2.5 times that, right?
Yeah, we do that, and we can rack that up a decade, right? We're at $1 trillion deficits.
We're at 25. We'll be at 60 in a decade, probably. Like just nothing ever changes. It just keeps on going up.
I know, but doesn't it feel like that stuff doesn't matter, and then until all of a sudden it totally matters?
Yeah. But it also feels like people have been saying this for a really long time and it hasn't mattered. So, I think that there is this tension between you're almost certainly right that at some point it matters. Lacey Hunt would say it's pulled forward a lot of the demand, and that's why growth is slow. And I don't think that that's necessarily a wrong perspective. Part of me wonders if low rates beget low rates because they fund these super long duration things like Uber, and that has a deflationary impact. And that,
especially when you default on it.
Yeah, and that means that, yeah, right. I mean, we'll see what they can do, but
I think that's interesting. I think that's right.
Uber was a 5-star stock on Morningstar. That's pretty shocking to me, considering who they are and what that is.
Dude, have you taken an Uber anywhere?
It's sweet. It's sweet. Yeah, that's my theory on low rates. I don't know if it makes any sense. I'm sure one of the listeners is going to send me well-justified hate mail, but
I think that's right.
I like to ask myself the question, what would 1972 Buffett write about on this topic?
He's just
hoarding. He didn't care as much about, like he wrote about like he would call things out a little bit more at that time period of his career.
He's written one in the last 10 years about. He said it's not carbon dioxide emissions. It's
dollar emissions.
Dollar emissions, yeah.
Pollution.
And he was again it. He's been pretty quiet for the last decade. It's got worse over that period. I think that he has done that a few times. His views are out there. I don't know what it doesn't. He just doesn't seem to hammer the view. He sort of makes the point and then
goes on with his life.
Yeah,
maybe that's what I need to do.
Gunlock's been hammering it. You can call up Jeff and see what he says.
Yeah, he says there's a 40% chance of going into recession last year. The 40% chance is just that's if you don't know what's going to happen, but you want to be able to claim credit for whatever.
Perfect. Yes. Yeah.
40%. Hey, I said it was. Then people are just like, oh, Gunlock said that was going to happen, but if it doesn't happen, he said I only said it was 40%. That's like 2 in 5. It's the 3 in 5 chance that it didn't happen.
That's right. Thinking in bets.
Yeah, that's not. Yeah, nobody like the 40% bet is much more common than the 60%, right? You never go 60. Because then that implies
depends on the payoff.
Well, but I'm saying in these like grandiose proclamations, no one says 60%.
No one remembers the ones that were wrong anyway. That's why just spray and pray. Just keep on saying it. Next year when it works, you'll be like, yeah, I got it right.
Somewhere Nouriel Roubini is still saying that we're about to all collapse. Right? He was right 10 years ago. He might be right again sometime soon.
Dr. Doom, yeah, he's been partying pretty hard. I think he's been dining out on that for a long time.
Toby, what's your topic for today?
So I saw this great tweet from Morgan Housel. Like every Morgan Housel thing, brevity being the soul of wit. It's alliterative. It's all of the things that I really love in a short little tweet. Buffett should buy Bloomberg. So Bloomberg's going to run he's running for president. Who knows what his chances are, but you probably can't go into that owning a big news organization. That's probably not a good look. So he's going to have to divest himself or stick it in a blind trust or something like that. So
doesn't Trump own Twitter? Kind of.
Psychologically.
Yeah, exactly.
So I think it's a good stock for Buffett because it's one of those things that it's got that lock in. It's a very, very high margin profit. It's got lots of lock in. I've been pitched like a dozen times over the last 10 years for all of these competitors to Bloomberg that they're just going to supply the data. So at some stage, I think somebody's going to come in, and I think it's $35,000 a year for a terminal. Someone's going to come in with we're going to charge you $10,000 or $5,000, give you comparable data feeds, and maybe they can compete. But from Buffett's perspective, it probably is a pretty good Buffett. And I think Morgan was pitching $50 billion. I've got no idea what the kind of money that he's making out of it, but Buffett's got the cash. I think it's a pretty good acquisition for him.
It's not quite 35 grand a year, but it's not cheap.
What is it?
It's
25.
67.50 a quarter is the most recent number that I can recall.
So it's 26 a year.
Yeah, ish.
27. Right? I said that if the deal gets done, they should give Morgan a sling from the commission, because the commission, I don't know what kind of commission you get on it, but it used to be like 3% on 50 billion is 1.5 billion. So they can give him 5% of that, which is still 75 million, and then I want 5% out of Morgan for suggesting it, which comes in at like 3.5 million.
It's not a bad haul just for piggybacking Morgan's tweet.
Quick tweet, yeah.
Do we know any of the numbers of the business in Bloomberg other than just like users and rough estimate at like revenue?
I doubt it. I mean, I do not.
I haven't seen any either. Is that not part of your Bloomberg feed?
No, Mike doesn't tell people how much he makes. Come on now.
It's crazy.
It's a perfect business for Berkshire. I mean, it would be perfect. And I've actually found that the terminal, as much as people like to hate on it, is a very, very solid product, and they're adding features to make it worth. I think the value proposition slightly better. I don't know. I just pulled up on Google. It appears as though the revenue is $10 billion, but who knows if that's true.
They were talking.
Let's see. SaaS
it trades at
trading at
5 times
30 times revenue.
That.
What's that get you?
I don't know. Even Berkshire might need to do an LBO.
When Renaissance started out, there was no good data. They started out before Bloomberg. So Bloomberg came on the scene with reasonable data, and it was a game changer for Renaissance and everybody else. So their motto is the best data is more data, and this is Renaissance, which I thought was kind of. I don't know. I don't know if that's I don't think that's my motto. I think my motto is the right data is the best data, but too much data kind of overwhelms you. You can't open up. And I think that's the only criticism that I've ever seen of the Bloomberg terminal was out of Guy Spear, and he said, I feel too good when I open it up and I start using it. So he had to move it into a different room, and it's at a stand-up desk, which I have a stand-up desk too. I'm the only value investor who's ever got turf toe from trying to read 10 Qs.
Pretty awesome that you can walk on that thing too. That's legit.
It's very good for you. It's
very California.
Good for the core. Yeah.
No, I don't know. I mean, I saw that tweet. I thought that was a really good take. If you can think of a perfect business that goes to Berkshire, he can promise that the employees will stay the same. He can promise the culture is not going to change. He can, it is theoretically set up perfectly. I hope he has not told Mike what he told the Mars family, which is never sell this thing. I hope he told him, you call me first. But I would be a happy owner of the Bloomberg terminal, even if it's a declining asset.
You don't have to sell, I guess. Trump hasn't sold it. As far as I know, does he? He doesn't. Does Trump still run Trump?
No, it's in a blind trust.
Right.
I think the way to do it is you get elected and then you can sell tax-free. That's how John Malone would do it.
Oh, yeah.
Or spin off a Bloomberg tracker stock somehow.
I did see recently, a friend sent me a little story about Malone that he was looking at buying a bunch of set-top boxes, and there was a company that was offering to make them, and it was going to be a pretty big deal for this company. Like they hadn't they hadn't delivered 300 million boxes before. And Malone asked as part of the deal for some warrants in that company.
Mm-hmm.
And those turned into more money than it cost for the order because of the kingmaker status.
He's such a gangster. That dude is a beast.
So he actually made money by getting the set-top boxes by cranking a warrant out of this company.
In case people want to fact check me on the QVC and Discovery statement from last week, that was out of Cable Cowboy. And that's what I was saying he used to do with these stations, right? They would come to him and they'd say, we have some content. And he'd say, all right, fine, you can get on my cable network and I'll take a little bit of your equity. He's a monster.
It's smart. So when you're telling that story, I thought, Jake, initially that he was buying set-top boxes for his house, but this was part of the deal. And then he didn't presumably get the warrants that went into the company.
No, not him, but TCI or whatever the vehicle was at the time got the warrants that turned into, 1.5 times the cost of the boxes.
I'll pay it, man. That's smart.
My buddy that's from the oil sector thinks that ultimately what happens with Occidental is they chew through all the synergies and then Chevron comes in and buys the lean company, and that's how Buffett wins because he's got the warrants. Which is sort of interesting. Good structure.
Just before we go, we have a question of the week. This one was from Jim. I'm not going to read his Twitter handle because it's a bit rude. But said, I mentioned Eric Cinnammon's Real Vision interview, which is a good one if you want to listen to one that's worth listening to. So any good value-focused podcasts or interviews that you want to recommend? Gents, what are your thoughts?
Well, I'll go first. Actually, I've been enjoying Eric's been writing recently more, and so I subscribe to his letters that come out, I think, once a month-ish, maybe a little bit more frequently than that, but I find them to be very high value add, so I'm a big Cinnamon fan.
What's the name of his site?
It's Palm Valley Capital or something like that.
Yeah, that's as far as I got to
have that wrong. But no,
we'll put it in the show notes. We'll give him a link in the show notes.
Yeah.
I've got two. I've been ruminating on Joel Greenblatt's interview with Columbia's Value Investing with Legends.
Yeah, that was
and
a good
then
one.
Real Vision did one with Dr. Gio Valiente, Sustainable Excellence in Investing in Life. That is a fantastic, fantastic podcast that I think everyone could benefit from listening to.
I haven't heard that one. I'll definitely go and listen to that one. So one, I mentioned it earlier, but it's a good one. Dan Ferris was on Investors Podcast. It's well worth listening to because Dan's got a crazy background. He used to be a professional or semi-professional Spanish guitar player, and I think he got whatever the finger equivalent of turf toe is, and he had to give it away, which is why he became a value investor.
It's brutal injury to be relegated to value investing. That's a real career ending right there.
One of the interesting things in Greg Zuckerman's book, he was talking about the guys were getting carpal tunnel from doing too much typing. So that's the big risk for a value investor. You get some sort of wrist injury from too much onanism or too much typing. I think we're coming up on time. So just before we go, I want to give a shout out to Donald at Guantanamo Bay. Thanks for the kind note. I forwarded that on to Jake and Bill. We're glad that you are watching and listening down there. Hope it's providing some interesting things to think about while you're there.
The first
shout out to all the troops.
Yeah, the first and probably last piece of fan mail that we'll get
from Guantanamo.
Happy to provide some enjoyment. I was hoping that someone out there would be listening to us. The fact that it's actually active military made me really feel good inside. So
yeah,
hopefully
too.
we can continue to entertain.
It was a great note to get. Thanks very much, folks. We'll be back next week.
Move with the rhythm, shake it up, stop when Cause no one can do it like we do it, like we do it, like we do it. Cause no